spend a little bit of time talking about expectations today and how those expectations may influence what's happening in the world around us, and also kind of how that gets internalized as well.
Yeah, I think we're sitting here at a time where there's a lot of volatility in the markets, in the political sphere, in the policy sphere. There's any number of catalysts that are driving stocks down in some respects, that are creating volatility in interest rates. And I think you said it before earlier this morning, Katie, how quickly sentiment shifts. The pendulum just swinging from everything presumably fine to not so fine and back and forth all the time.
Yeah, there's that constant shift. And, I think it comes at us from a lot of different directions, but we did start out the year, pretty positively. And I think that expectations for market returns were fairly strong. And there are a lot of great things happening around us. There still are a lot of great things happening around us, but it is fascinating. There's never that middle ground of how people are thinking and feeling about things. It's either really high, they feel good about, recent returns, how things are looking, how that might impact the long-term picture for them, or they're feeling really bad, concerned that things are going to move quickly to the downside. And we do seem to be on both extremes of that pendulum.
And it kind of speaks to the basic fundamentals. Today, we're going to talk a lot about the investments themselves. A lot of times we'll talk about investing philosophy and how to approach aligning your investments with your financial plan. But let's start with, why do stocks go down? Why don't they go up all the time? It's because our expectations of the future change. If we're expecting things to be here, end up here, that's going to be a gap. Stocks are going to respond poorly. But if we expect low and they turn out high, that's why stocks go higher. And I think there's just a resetting of expectations right now, and it's turned into a lot of volatility.
Kind of getting a little bit granular with those expectations. That's what PE ratios are all about. Those price to earnings ratios are setting the expectations for how successful a company is going to be. And so if there's the expectation that price to earnings is a higher number, a high PE ratio, then they are assuming for multiple years we're going to have positive earnings. So when there's a call to say, actually maybe the company's slowing down a little bit, that's where that expectation really influences how the market might perform in the short term, because now it's jarred those expectations for those corporate returns, which show up for us in market returns.
Yeah, and we've talked before about how there's this idea of, it's not whether things are good or bad, it's whether they're getting better or not much better. And there's always that little bit of wiggle room. And with the stock market being down this year, and we're having another volatile day today as we're recording this, we have to recognize that this is all part of the natural state of things for a stock market. If we thought that stocks would only go up all the time, then there wouldn't be any such thing as diversification. We just go all in and leave it there and just call it a day. But that's not the way. And even within a diversified stock portfolio, there's a lot of very nuanced stories happening out there right now.
When we think about the makeup of the US markets versus some other markets, we are very tech heavy. And so part of this is cyclical and asset classes as well, whereas other markets could be more financials or manufacturing or, more dependent on other sectors. And so it's a combination of, what's happening in the US, but then also a combination of just how the different tides will flow over time.
And because there's so many different stimulus out there, there might be a dozen different issues that you have to factor in, everything from inflation to interest rates to recession risks to geopolitics, all of those things. And they're going to affect different asset classes in different ways. I think one of the mistakes that investors make sometimes when they look at their investment performance is they look at the whole balance. Is my balance up or is my balance down? Whereas we're talking about, there are certain individual stock sectors that are performing nicely right now while others are down. And you have to kind of understand the nuance to that and just recognize that you have exposure, but it doesn't prevent everything from going the same direction at the same time. But that's a security blanket for your investment strategy.
Yeah. You know what, Dennis, you brought up something really important right there. When you talked about those different areas, whether it's a geopolitical risk, whether it's, inflation, interest rates that are impacting things, or maybe it's just different economic factors. There are so many different things that can shift an expectation, and it's going to show up in a different place. So it goes back to that whole thought process of we can't protect against one particular threat because we don't know which threat is going to impact or is going to rock that apple cart. So we really do have to make sure that we are disciplined with the fundamentals of diversification and rebalancing and all the things that help position clients at their risk level for the long-term growth, because we don't know what that short-term nuance is going to be.
Also, and it's not just a stock thing, I think one of the things that we've learned in the last few years, we've really tried to educate our clients on the role of bonds in their portfolio. Yes. Because stocks are going to make the evening news. If we have a down day on the S&P or the Nasdaq's down a few percent, that's going to lead. But for most diversified investors and most of our clients, they're going to have a balance in high quality, short and intermediate term bonds, and their role is to be ballast during times like this. When you talk about how do you prepare for it, how do you prepare for a time when the stock market is down? You own a bond portfolio that's going to be performing in a different way for different reasons. Now, we've had years that were bad for both, like 2022 is one of the worst examples where stocks and bonds were both down. That's not the case this year. As we've seen a sell-off in equities, bonds have held their ground pretty well in the positive territory.
Yeah. It might be worth talking a little bit about how the bond market landscape is different today than it was in 2022 and why we're seeing some of that reaction shift. Do you want to share a little bit about just some of the differences between the markets?
Yeah, we're at a different starting point. I mean, we were at or near zero on the Fed funds rates in late 21, early 22, and the Fed started raising interest rates fast. And when that happens, you get a big downdraft in your bond prices. Interest rates up, bond prices down. Now we've had higher interest rates here for a little while now, and we've seen them tick lower recently. There's been a little bit of volatility there, but there's some cushion that if something happens in the economy, a recession, or fear really hits, the Federal Reserve has wiggle room to go down. And when that goes down, your bond rates appreciate. So again, you have to own it before it happens. You can't wait until you need the protection and then swoop in. But this is kind of the functioning, what we would consider kind of a normal functioning time of turmoil, which happens on a pretty regular basis.
Yeah, you're exactly right. There's more cushion in there than we had before. Like there's just no place to hide in 2022. Right. There's no place to absorb the Federal Reserve's movements, and also they only had one direction to go. It makes a difference. But
Katie, one other thing that I like to pull up, and I've been using a lot with clients recently, is pulling up like anywhere from like an 8 to 10 year chart of the S&P 500 and showing this window of time going back to, call it 2017, 2018. In that time, we've had 3 different periods of at least 20% pullbacks in the S&P 500. And then I pull up the annualized returns, the 1 year, 3 year, 5 year, 10 year, 15 year. Even with that terrible bear market of 22, the COVID pandemic, and what we had at the pullback at the end of 2018, over the last 10 years, the S&P 500 is still averaging 12.7% per year. In the 5 year, it's averaging 16%. In the 3 year, it's averaging 13%. Eventually, it starts to look like the back of its baseball card. This is the price we pay for those types of returns, is that the risk has to be wrung out and then rebuilt, wrung out and then rebuilt. It's what happens in a normally functioning market. It doesn't feel good, but that's the reward we get for taking on that risk.
It's always interesting too to look at charts like that, just to look at the line of the S&P 500 over that time period, because there's a general overall strong trajectory, but then you see like the 2018 is like a boop, and then the 2022 is like boop, or the 2020 and 2022, like how looking in that rear view mirror, it's easy to forget how stressful it was in the moment, and then now to feel like this is more stressful than it's ever been, because we almost kind of, gloss over with time how stressful it was in the moment. And I distinctly remember 2018, 2020, 2022, certain clients saying, what if it all goes away? Like, what if it's gone? and I know like those are real feelings. Those are real concerns. And I don't, ever want to be dismissive of that by any means. But zooming out and kind of putting some of that back into perspective, even looking at it after the fact. I know that's something that I sometimes talk to my clients about too. Like I will pull up those older charts to say, remember how awful this felt? But we continued to to work, through the process, and you're continue to be in a strong, trajectory for your goals, your retirement, whatever they may be. So.
Yeah, and for a client who's at or near retirement or just has a more conservative stance in general, it's sometimes we need to remind them that, hey, you have a lot more in bonds than you think. Not everything's going down today. And then for a younger client, someone who's still in the accumulating years, like this is the time you make, hey, this is when we check in to make sure you're maxing out your 401k contributions. Like these are, for someone who is 65 years old and have been saving in a 401k for over the last 30, 35 years or something like that. The decade of the 2000s, a lot of hay was made. That was a big down decade. So you're just buying in and doing that. So there's good discipline to be had, but it's emotional right now. It really is, and it stinks. Warren Buffett has this line about Mr. Market. Mr. Market is sometimes grumpy and dour, sometimes enthusiastic on what's happening, but always emotional. And our job as investors is to try and understand what we own, the stocks, the bonds, the diversification, and maintain our cool and maintain that good discipline, because that's what gets us through the other side.
Yeah. I think this has been a really good discussion, Dennis. And we do welcome these conversations. We welcome the conversation. When clients or individuals, they have concerns about what's happening, and for us to kind of dive deeper into their specific situation and make sure that that risk profile is dialed the right way. So please feel free to reach out to us.